The Moving Iron Podcast is brought to you by these great sponsors. Are you looking to value your equipment more accurately, target the right buyers and close more deals, reach your ideal customer? Then look no further. Fusable isn't just about ag data, it's about action. Our best-in-class solution empowers you to value your equipment accurately, make informed decisions, and find the perfect prospects. Ignite your dealership's growth at fusable.com/movingiron-podcast. Out in the field, every decision counts. You wouldn't plant without testing your soil, so why would you prospect blind? Introducing EDA, your one-stop shop for ag equipment intel. EDA goes beyond specs and prices. You get deep dive data on every piece of equipment like UCC filings that help track ownership changes and uncover potential sales leads. D&B firmographics, which help you understand the financial health and buying power of potential customers. Market trends that help you stay ahead of the curve, and insights on equipment demands and pricings. With EDA, you're not just looking at data, you're seeing opportunity. Find the right buyer, sell smarter, and build lasting relationships. Visit edadata.com for your free demo and unlock the power of knowledge. For over 80 years, Iron Solutions has been your go-to data source for ag dealers, lenders, and manufacturers. Get powerful appraisal and value forecasting tools that fuel profitable decisions anytime, anywhere. Get your free demo at ironsolutions.com. Iron Solutions, confidence in every click. Today, there are many ways to finance ag equipment, but nobody delivers simple, fast, or flexible financing like AgDirect. Learn more about your options to buy, lease, and refinance equipment at agdirect.com. Valley Transportation has been hauling ag and construction equipment across the country for the past 33 years. Call Parker at 800-657-4910 for all your trucking needs. At Valley Transportation, our goal is to help you reach yours.
When you partner with Axon, you immediately gain access to a full range of products and solutions designed to meet the complex needs of today's grower. We carry all major brands and sizes of tires and wheels. We specialize in large diameter wheels for large equipment. We have one of the largest OEM replacement wheel inventories in North America. Known for extreme flotation setups, duals, and triples, we have wheels for all makes and models of tractors, sprayers, combines, and grain carts. If we don't have the wheel in stock, we'll custom build, sandblast, and paint in-house. There isn't a more vast inventory in North America dedicated to helping dealers move more iron. With facilities on the West Coast and in the heart of the Midwest, leverage our 230,000 square feet of indoor inventory to solve any problem a grower may have. Move more iron with Axon.
Moving iron in the 21st century. Hard-working people working hard for you and me. Moving iron time and time again. Through the years you'll find us here. Moving iron.
Hello, and welcome to Moving Iron Podcast Markets with Shawn Hackett. Shawn Hackett is with Hackett Financial out of Boca Raton, Florida, and he's nice enough to come on and talk about what's happening in the world of commodities. Shawn, how you doing this morning?
Doing good, Casey. Doing real good. We have had some non-wet weather down here, which we've had the wettest winter I can recall. So I'm enjoying that weather before I head back out on the road to Ohio later this week. So
Ohio later this week. Okay. What are you going to be speaking out there? Who are you going to be talking with there?
it is going to be it is Highland County Chamber of Commerce.
Highland County Chamber of Commerce.
Yep. It's it's in Hillsboro, Ohio. They're having it actually at a big farm there. They're having a big meeting at one of the big hangars they have at this big farm there. So,
well, that'll be fun. Yeah. Well, if you're in Highland County, Ohio, check out Shawn at the big farm there. So you'll enjoy that. All right, Shawn. Everybody is ready to jump off the cliff right now at the price of where the grains are at right now. You put out a pretty good report earlier this week, kind of talking about this is the panic selling, panic, area of what we're at now. And you laid out some pretty nice historical picks of stuff and how things played out during these times, what that looked like. Got a lot of things in the favor of grains right now. If you look at long-term stuff out there, you've got, Brazil is past 50% planted. Our harvesting sorry, of the the beans that are down there, and then they're going into second crop corn planting right now. That's most that's been planted. We're going into the growing side. It's still been dry, just like we saw with the soybean side of stuff, John. So I just talk a little bit about the sense of panic that you read about, and some of the things that you see out there that can be in grains favor here as we move forward into the year.
Well, I mean, my view is if you want to study how a market bottoms, you should study past bottoms, right? I mean, you should study when it panics in commodities. It's not unusual; happens all the time. Because you have highly leveraged vehicles. So, in past grain market panics, what kind of things have we seen that preceded it? First of all, we've typically seen speculators get record short as a percentage of open interest. We have that. We typically see the rate of change, the 2-year rate of change, achieve a 30% decline or more, meaning that prices have declined over a 2-year period of more than 30%. We have that. We look at relative value, which is the relative value of corn relative to all other commodities. When you get a particular commodity it reaches, an historical low point relative to everything else, meaning it's getting too cheap relative to everything else, you tend to precede a panic low. We're seeing that. There's a lot of technical tools you can look at that that can give you senses of oversold, relative strength, Bollinger Bands. I mean, I don't want to get too far afield with this kind of things, but all of them are kind of lining up to where historical past panics have reached their crescendo. It doesn't mean it can't go down tomorrow. I mean, you're picking the exact moment. I'm not saying any of these indicators can tell you that, and you don't need to know that. You just need to know when you're close. And so from all that perspective, everything says to me, that we're definitely getting the kind of myopic, death cross kind of sentiment that you typically see when a market is ready to make a low. Now, when we look at outward reasons, it's not rocket science. Everyone pretty much knows that when you have harvest, you typically get harvest pressure until you've reached a 50% harvest point, and then everybody who has to sell or had to sell because they didn't sell or they need to sell has sold. And then the pressure valve comes off for a little while. I mean, post-harvest rallies are notorious. It's common knowledge that this is what happens typically. And so we're now reaching that point for Brazil, which means the extremely low cash price for soybeans is starting to alleviate. It's starting to back off a little bit, and we should see that pressure come off. It doesn't mean a wild bull market. It just means that pressure comes off, and it allows the opportunity for the market to see a rally. Obviously, we know second crop corn in Brazil represents almost 80% of production, so it's the key for their production, for their balance sheet. Planting is just finishing up. If you go down 1 meter layer, you can the satellite can actually figure this out now, where they could go penetrate 1 layer down and to tell you what the moisture content is. It is the driest moisture content 1 meter down that we've ever seen since we've been measuring it. So what does that mean? That means that in order to have the crop come out okay, you have to keep getting rain to keep the topsoil wet because there's nothing underneath, right? Meaning you just have to keep getting rain to keep the topsoil. If you don't, very, very quickly, you're going to get a flash drought, because the minute the topsoil dries up and the corn plant's going to look for moisture beneath, it's not there. It's going to have trouble. It's going to be starved for moisture. So that to me, says that you're starting. That's not the way you want to start a crop off at, especially your big crop. And so if we go into this mid-March to early May, which is the core pollination period, and we have below normal rainfall, we don't get that consistent rainfall, we're just going to have a crop that's going to be in a lot of trouble. I think the market's going to start to need to put some weather premium on. If you look at I don't think too highly of weather models, but Casey, the market trades them, so we always have to talk about them. But the weather models, which I happen to agree with this time because my work says the same thing, there's just not a lot of rainfall for Mato Grosso, that central west, where most of the second crop corn is grown. It just looks really dry for weeks out, and I just can't imagine the market's going to look at that and say, "Oh, we're going to keep cash U.S. corn at 375." I don't think so. And so we're going to put some weather premium on, and of course, if that forecast holds out or continues on into April, then we could have more of an explosive move to the upside, because then the market's going to have to significantly, downgrade the crop potential. And, and like I said, they were the number one exporter of corn in the world last year. So to say that doesn't mean anything, I would argue it means a heck of a whole lot. So that's there. And then, of course, just because the first window of the polar vortex here in mid-February missed, meaning that the polar vortex stretched in the different direction than we were anticipating, meaning it stretched into Eastern Russia, Asia, China. They all got crazy cold and snow. Doesn't mean that what happens is it stretches, it recoils, and we spin, and then there's an opportunity for multiple stretches. And so we stretched in North America in January. I thought it was going to happen again here mid-February. It didn't, but there's another opportunity for a few more stretches. And I think there's a better than average chance that some of these stretches could push into North America. The warmer weather that we've seen only makes more wheat coming out of dormancy. It makes more wheat start to grow. It makes more wheat start to be more vulnerable. And remember, as time goes on, you need the cold temperatures you need for winter kill go up. In January, you need minus 20 degrees to get a winter kill. Now you just need a few degrees below freezing. So your barrier for getting winter kill is rises. I'm not sure if all people understand that. Everyone thinks, if it's 30 degrees in January, no, you're not going to have winter kill because it's in dormancy, and so very, very vulnerable. If you saw yesterday, KC wheat was disproportionately outperforming SRW because there's some hint that we might get a quick cold shot here next week in the center, where all the KC wheat is grown. You only need 4 hours, one night to do the dance. It's not like you need days upon days of cold weather. You just need a quick shot, especially when the crop's so unbelievably abnormally out of dormancy and actually starting to actually grow. It actually needs moisture right now. So that risk, even though the market has ignored that risk, doesn't mean the risk has gone away. It's still there. And so, and of course, the forecast we have for May is completely different than the winter. Spring is spring, winter is winter. What drives those weather forecasts are completely different factors. So I keep getting this question over and over again from my customers that are asking whether this warmer period here in February, whether that alters our forecast for a risk for a May freeze, and it doesn't change it at all. What's going on with the polar vortex stretch is a completely separate item from what the spring pattern is going to be. So that's also still on the table. So when you put all this together, it sure seems to me like some speculators are going to say, maybe, we should take a little length. We should take some of our short position, ease it up a little bit, take it off a little bit. Now that some of these other risks are starting to come into the fray, the dollar, generally speaking, has been a little weaker. Just China is finally talking again because they're out of their vacation, their year-end holiday, and they're starting to make stronger comments that they're going to support the stock market, support the economy, and they put some orders out there for Brazil soybeans. We saw that even corn exports yesterday, corn numbers yesterday for deliveries were very, very strong. Not from China, by the way, just from others. So when I just look at all that, it just seems to me, we might have at least initially traded our initial attempt at a low, and now we're going to begin actually go up for the first time in a couple of months, because we've literally been down 2 months straight. I think we've been down 12 straight weeks in a row. I think, if I looked at my chart correctly yesterday, or 8 straight weeks or something like that. I mean, it's been we haven't had an up week in a while. This might be our first up week that we've had in several months, which, markets can go up, actually. People forget that. So
Yeah, they do move around.
they can go up.
True statement. So you talked about the situation again before we started recording. You were talking about some of the stuff in the soft market. We're looking at stuff in the cotton market right now. The cotton is right now with $1 a pound. So how'd you put it? You called it a commodity. What did you say?
Yeah. Usually, what happens when commodities go down? They all go down. Everything goes down. It's a big deflationary crash. So when we had the 97 Asian currency crisis, the commodities all crashed. Everything went down. 08, 09, everything crashed. Well, September 11, everything crashed. COVID, everything crashed. We're not seeing that this time. Certain things are crashing, other things are exploding. So I called it when we were talking, I call it commodity pickers market, because you have cotton breaking out almost $1 a pound now on the nearby. That's some of the highest prices we've seen in over a year. You have cocoa at all-time highs, still surging. You still have orange juice, near the highest levels ever. We've seen some sizable rebounds in livestock. So it's not all, but yeah, natural gas has crashed. Crude oil has really taken on the chin. Energy's been really bad, but gold is near the high. So it's really not it's just not your normal commodity deflation cycle. It's really bifurcated, and that's actually, to me, is encouraging, because it says what's really going on is more of a, every market has its own set of fundamentals. Every market has its own set of seasonalities. Every market has its own different set of drivers. We really should never trade them all together. Why cocoa and corn should go up and down together is preposterous, but the markets do what they're going to do. So what I like about the market we have is that it's not saying to me the sky is falling. We're going into a depression. There's no demand for anything. What it's saying to me, is their market is trading individualized, perceived fundamentals in each market, not trading the whole thing as one asset class, and that's actually favorable, because it says that given that the grain market depression that we're seeing, which we can go over, we've gone over all the reasons that it's happening, is really not likely to be an enduring situation. I mean, we're not likely to see grain prices stay low for long, because it's really not a commodity deflationary cycle. It's just that the grain markets got themselves in a little bit of a tough spot after a couple of years of incredibly high prices, by the way. So I think it's a grain specific issue, not a commodity specific issue. And as such, we wouldn't expect years of depressed prices in grains like you would normally expect if we had everything falling, because we have a kind of a deflationary, depressionary kind of commodity markets. Right now, we're seeing a lot of markets acting very, very well, given a different fundamental factor, which means if the grain markets find a more favorable, friendly fundamental factor, the money will come in and buy it. It's not opposed to buying commodities. It's not like it's shunning the whole asset class. It's just shunning grains right now, because we've had a series of bearish forces that have conspired to create, where we are, this panic. So to me, that says that's good news. That means that this is not likely to be a multi-extended year of low commodity. It just means that right now, grains are on the wrong side of the trade, but 6 months or 12 months, they're likely to be on the better side of the trade, and probably cocoa and orange juice and cotton are going to be making, 1 year lows. I think there's going to be a lot of yin and yang, give and take, for the foreseeable future. And to me, that's a much better market to be in than if it's, and it's just commodities are shunned everywhere and there's no hope, no future. Those can last a long time, like we had between 2012 and 2020, where most all commodities were just in the tank simultaneously. Right now, we're not seeing that. We're not seeing that at all.
So we'd be remiss here if we didn't at least point out the fact that while grains are struggling, it's a great opportunity for livestock producers to lock in some low feed rates right now. So I guess Shawn, talk a little bit about that.
Well, look, we've stated on your show, and we've stated in our conference speeches all the time that we're in an extended period of significant price volatility. We're in a price volatility cycle. People always view that as, upside. Well, no, it means up and down. Volatility means up and down, right? So we had the up after COVID. Well, we had the down into COVID. We had the up after COVID. Now we have the down. We've had wild price swings. And those are going, in our view, going to continue, which means both sides are going to get a great chance to bring more money home on the farm. Right now, $3.75 cash corn, depending on your exact basis levels in your local area. December 2020 is the last time a livestock producer had a chance to buy cash corn, at that price level. And why you wouldn't be locking that in now to a large degree, in some shape, way, or form is beyond me, because, this is under almost every circumstance I can see, sub $4 cash corn is going to work in a livestock operation. And so, there's a tremendous opportunity. Bean meal, in the low 300s, it can be 500 a ton at times. It wasn't too long ago, it was 475 a ton. And now you're in the low 300 a ton. Very, very interesting opportunities for livestock, for end users of all kinds to do something they wish for the last several years. They wished they had been more aggressive during COVID lows and when we had those prices offered. And then, of course, the livestock guys were chasing these high prices, and it hurt them, greatly hurt them. Well, now you have an opportunity you get a second chance at the wheel. You get a second chance, and so the way it looks to me is, the market's saying, okay, you missed 2020. Here you go. And unfortunately, we just talked before we started your recording this. History repeats. Every time people say, if I ever get another opportunity to buy $3.75 corn, I'm going to do it. Then it comes here and they won't do it. Yeah, but it could go through.
It could. You could still buy $3.75.
Just start accumulating cheap feed. No one knows where the low is. Yes, it could go lower, but you have to step in at some point and say, this is going to work under multiple scenarios in my business. I need to start averaging in, increasing length, because if you don't do it now, then what are you going to do? By the time, if corn starts to really get into a bull market because of weather or some other reason, it's going to be when it gets like north of $5 futures. When it breaks $5 futures, everyone's going to start getting excited. Oh my gosh, the bull market's back. So you're not going to get your technical confirmation that the corn market's in a bull market until after it crosses well over $5 to $5.50 futures. And by the time you get there, so what's your cash corn going to be then? You're 5 cash, or that's your strategy? You're going to wait for confirmation of a bull market so that you're going to buy $5.50 cash corn because that's now a good deal when you had an opportunity today during a panic to buy $3.75 cash corn? Makes no sense to me why you would do that. Sure, keep some powder dry. I'm not saying buy it all, right? But come on, guys. If you're an ethanol plant and you're not locking in $3.75 cash corn, if you're in the livestock business and you're not locking in some 375 cash corn. I mean, some places 350 cash corn because in certain regions where the base is even wider. I don't know. I just think you have to look at your long-term operation, because livestock, last time I checked, people aren't in it for a year or two. They're in it for 10, 20, 30, 40 years. You have to look at your feed needs, and that on that basis, you need to look at your feed needs on a multi-year basis, not a multi-month basis. Yes, hand to mouth has been a great strategy, and it's allowed you to participate in seeing these prices fall week after week, month after month. Get it? But at some point, and we've shared where we're at on that point, you have to appreciate where we are in the marketplace. And the good news about a very volatile, price volatile commodity market that we're in is that you're going to get multiple chances to do what the livestock producer can do now and what he had a chance to do in 2020. And as depressed as the producer is right now, he's going to get more opportunities to do what he was able to do in the last couple of years. If you don't like in this environment, in this very volatile price environment that we see continuing at least for the next decade, if you don't get too excited when it's very, very high, because it's going to come crashing back down, and don't get too depressed when it's really, really low, because it's going to come back up. That's what price volatility means. I mean, you look at the price volatility that we had in the 1970s. I mean, just wild swings over and over and over. Just, so get in the habit of, selling those rallies and buying those declines. And when just really get in the habit of trying to go against the sentiment in the marketplace. Everybody wants to be told they're doing something smart, right? Everyone wants to feel like people are telling them that they're doing the right thing. Buying corn right now, everyone says you're an idiot. You're a moron. How could you possibly buy corn? It's going to 3. It's going to 275. All these ridiculous forecasts that are being put out there now by people out there. You have to just ignore all that, because those guys aren't going to pick the low, and they certainly aren't the guys that are going to pick the top. They're what I call their fair weather forecasters. They just tell you what the sentiment is at the moment, because that's what's popular. And when the market turns, they say, well, who could have known? Everybody got it wrong. Still listen to me. I know what I'm doing. And I'm not picking anybody out specifically. I'm just saying it's how the market operates, especially in today's market. Everyone's a fair weather market forecaster. The media are fair weather market. I mean, whatever the trend is, they just keep pumping whatever stories they can to support the trend until the trend changes, because that's the market we're in. Social media, AI, it's just feeding into momentum-driven forecasting. But that's not how you bring more money home on the farm. You bring more money home on the farm by thinking about economics on the farm, by thinking about, is this a profitable price? What's the historical context of this price? Everyone knows that historically, that the unpopular, the contrarian, the contrarian point of view is how you are able to sell tops and buy bottoms in terms of cash corner, cash, on either side, because we know that everyone is mostly bullish at the top, and we know people are mostly bearish at the bottom historically. So if that's the case, then you shouldn't be selling when everyone is bearish, and you shouldn't be buying when everyone's bullish. You should try to get in the habit of doing the opposite when you feel that you're at those important lower boundaries or top boundaries. And we've discussed some ways to do that. Another way to do it, Casey, is you look at what's called pattern recognition correlations, which means you go back and you say, when did the corn price on the December contract or the July contract trade similarly since 1970? Like, when have we had a similar price pattern? And you look back and you say, okay, well, let's use an 85% correlation coefficient. And you match these different years, right? And you say, okay, well, these 5 years are pretty close, meaning whatever the psychology was for these years that made the market go up and down the way that it did, we're following that same psychology, right? Because that's what the market is. It's a psychological barometer, and we ran that now. It's not perfect. Correlations don't last forever, but it at least in the short run, it kind of gives you an idea that based upon that analysis, it's showing that the market should start to turn up in March. Now, I'm not saying it's definitely going to turn up in March. I'm just saying that if you look at 5 prior years that had a similar 85% or higher correlation coefficient to how the corn market is trading right now, is suggesting that the market should, at least in those years, would be expected to turn up in March. So do you live and die by that indicator? No. It's part of a whole series of other things, and say, okay, well, this fits in with the idea that we're in the process of getting close to a low. And what you want to do now with this piece of information is say, okay, do we turn up in March? If we do, then those price pattern models are we want to continue to pay attention to them until something happens where we diverge from that behavior. It's just another way to, figure things out, Casey. It's, like I said, all I'm trying to say, there's no magic bullet that says this works every time and this is perfect and this never misses. It's a series of things, but what I'm saying is that all these things that we just discussed are saying that, this should be a really, really good area to lock in physical corn, to lock in physical meal. Like the buy side of these markets, the physical buy side of these markets, this is your time to do something smart. So we're advocating that for anyone that will listen. Not everyone will, but we're advocating that this is a time that the end user is getting a great opportunity, just like the producer got a great opportunity to sell in 21 and 22. And if you don't and you chase the market higher, maybe the next time you'll act differently than you did the time before. I mean, unfortunately, if you want different results, it's a cash phrase, but if you want different results than the results you've been getting, then you need to do something different than you've always done, right? I mean, It's always funny how, and I'm guilty of as everybody else, we want different results, but yet we do the same thing we always have, and then we get the same results we always have, and we're pissed off that we didn't get a different result. Yeah, but you got to do something different.
Right.
You're only shot of a different outcome. You got to do something different. Now, maybe that different didn't work out this time, but you got to do something different until you find what works. And that's always we love to fall back into our comfort zone, whatever that comfort zone is. And right now, I'm seeing very similar actions being taken where farmers are selling into low, and end users who swear that they were going to buy all the corn they could under 4 are now balking. And to the extent that I can turn some of those people around and to make a different decision, hopefully I'll be a little.
All right, man. Lots of stuff to think about there, and you're exactly right. You want something to change, you gotta change what you're doing. So that's true for sure. So Shawn, appreciate you being on the podcast. Folks want to reach out to you, get more information on what you're doing, Hackett Financial. What's the best way to do that?
2 best ways is our website is Hackett, HACKETT advisors.com. Also, we have a Twitter page at Faradex, that's F as in Frank, ERIDEX 11. We also have a LinkedIn page. From time to time we put stuff out there. We're not habitual posters. We don't believe in spending our time surfing social media. We rather do research and give good advice. But from time to time, we do put some stuff out there that people can follow to see if the way we look at.
Right. Shawn, thanks for being on, man. We'll catch you again later this week.
Sounds good, Casey. Take care.
Right on. I'm Casey Seymour with Moving On Podcast. Check me out on Facebook. Put on Instagram at Moving On LLC. Go to LinkedIn at Moving On Podcast. And check me out over on the YouTube channel, which is the Moving On Podcast YouTube channel. And you can find us on TikTok and Snapchat, same place. Go to movingonllc.com, got a brand new website up, and it's all running. I'm sure there's some things I need to fix yet, but I'll find those along the way as those keep coming up. But it is up there for everyone to check out. Shawn will be at the Moving On Summit coming here in November 4th through the 6th. if you're interested in getting more information about that, send an email, leave it on the podcast or leave it on podcast.com. And I'll be sure to reach out to you with those answers. So with that, I'm Casey Seymour. We're Shawn Hackett. Let's move on, folks.
The Moving Iron Podcast is brought to you by these great sponsors. Are you looking to value your equipment more accurately, target the right buyers and close more deals, reach your ideal customer? Then look no further. Fusable isn't just about ag data, it's about action. Our best-in-class solution empowers you to value your equipment accurately, make informed decisions, and find the perfect prospects. Ignite your dealership's growth at fusable.com/movingiron-podcast. Out in the field, every decision counts. You wouldn't plant without testing your soil, so why would you prospect blind? Introducing EDA, your one-stop shop for ag equipment intel. EDA goes beyond specs and prices. You get deep dive data on every piece of equipment like UCC filings that help track ownership changes and uncover potential sales leads. D&B firmographics, which help you understand the financial health and buying power of potential customers. Market trends that help you stay ahead of the curve, and insights on equipment demands and pricings. With EDA, you're not just looking at data, you're seeing opportunity. Find the right buyer, sell smarter, and build lasting relationships. Visit edadata.com for your free demo and unlock the power of knowledge. For over 80 years, Iron Solutions has been your go-to data source for ag dealers, lenders, and manufacturers. Get powerful appraisal and value forecasting tools that fuel profitable decisions anytime, anywhere. Get your free demo at ironsolutions.com. Iron Solutions, confidence in every click. Today, there are many ways to finance ag equipment, but nobody delivers simple, fast, or flexible financing like AgDirect. Learn more about your options to buy, lease, and refinance equipment at agdirect.com. Valley Transportation has been hauling ag and construction equipment across the country for the past 33 years. Call Parker at 800-657-4910 for all your trucking needs. At Valley Transportation, our goal is to help you reach yours. This podcast is proudly provided by Axon, helping dealers move more iron for the past 100 years. Find out more at axontire.com. Move more iron with Axon.
Moving higher in the 21st century.